Hey everyone, this is Ryan Mallory for SharePointer.com. Today is November 14th, 2013, doing another video with you guys here, summing up these markets because it's been a little bit of a different, kind of a hokey market this week, quite honestly. And just going over some lessons learned with different stocks and also some of the bigger, um, wider followed stocks out there in the market right now today. So, with that, let's go ahead and jump right into the S&P. We had the huge breakout yesterday. Everybody knows about that. Gap down, bounces right off of that 20-day moving average, and we finish, dramatically higher. We engulf like an entire month's range of action outside of these 2 days here. But I mean, that was some heavy lifting by the market. So that was a big day, and then we're getting the follow through today, and I think that's equally as important because it shows that it's less likely to be a head fake here. However, I would point you back, and this is something that is on my mind because when we've consolidated in recent past, and quite honestly, we haven't seen a lot of heavy consolidation periods like we have, from October through November here. The last significant one was back in July, August time period, and we did end up breaking through it in similar fashion back on August the 1st, and then on Friday we followed through with it, but then the subsequent price action was heavy to the downside. We had, and there's another example here too, right here. We broke out hard on April 10th to the upside, and then we sold off dramatically the following day. So there's some concerns on my end about how high can this market really go. I mean, it could ignore those two trends. I don't know, but we are pretty heavy to the long side nonetheless. I will be curbing some of my long exposure, probably 20% or so of my long positions will be cut today. I've added about 3 new positions today, so I want to offset that with some less long exposure, basically. And when you look beyond what's taken place today and yesterday, and you see like on Monday we had the low volume day, and that's a great way for like market makers and just some of the heavy traders to be able to manipulate stocks a lot more because of the low volume, because some of your stocks that might typically trade with like a 500,000 shares a day is only trading with like 200,000 shares a day, and so the bid and ask is pretty thin, and they can be easily manipulated, which creates a little bit more of a whipsaw action in those particular stocks. So that was a little weird on Monday, and then Tuesday it improved some, but I mean overall, I mean we've had a positive week. However, yesterday and today there's been a couple of bumps and bruises along the way, particularly with CTXS. And subscribers know about this one because we were actually trading in the positive on this one until yesterday afternoon around lunchtime, when there was some news that came out that connected it to Amazon, and I was really excited about this stock, quite frankly. I mean, we had a nice double bottom, we were breaking out nicely, we were up on the trade, and then that news came out, and we ended up getting out for about a 3% loss on the trade. And this just basically came out of nowhere and just sank the stock instantaneously. That's why you have stop losses in, though, okay? Because as good as I might be at trading and consistently booking profits out of the markets and with my trades, there's no way around these unknown events. I mean, I could have been in the bathroom when CTXS hit, and if I not had seen that happen, instead of getting out at 59, I would have been getting out maybe at 56, and so you need to use stop losses. I know some people talk about using mental stop losses. I'm more for the hard stops. I put them in every day. I don't hold them. I don't do good to cancel stop losses because the perfect example of that is an ALKS today. You look at this stock here. All this thing did is whoever the market maker was on that flashes an ask right below a whole bunch of people's stop prices right when the market opens. You don't even see the ask. It's literally like the blink of an eye. You don't even see it, and so everybody starts getting stopped out because their ask went below their stop loss price, and if they had their stop loss at say 36.25 and they flashed an ask at 36.24, there might not be any sales that take place below 36.24 or at 36.24. Instead, people will probably get filled at like 37.20, and then they're like wondering, how in the world did that happen? Because I didn't even get stopped out of my trade at all. And so you get this little, basically they're stealing your shares when they're doing that. So always happens, or when it happens, it always happens at the beginning of the trading session. So you want to avoid those things. So the only reason why I know that is because I've had to deal with that myself. And I was stubborn about it at first. I was like, oh, I'm not going to put in my stop losses every stinking day. That's such a pain in the butt. I don't want to do that. But you know what? You lose enough money to these goons that are doing this to you, and you start realizing that, you know what? I'm going to put those in every day, and that's what I do. And I think it's a great way to. It doesn't happen all the time, but when it does happen, it's always in the beginning of the trading day, and it's better just to put them on after the market opens. Right when it opens, just start going ahead and putting them in one after another, because when they do this stuff, it's like right at 9:30 and the second that it opens. So be aware of that. It's unfortunate that they get away doing that kind of stuff, because it is pure nonsense and trickery and everything else. But that's how the market works, and we get to be participants. We don't always get to dictate. Rarely do we get to dictate what it does and how it's regulated. So yeah, CTXS got stopped out of that one. ALKS, we're still in it, and we probably would have been stopped out of that today had I not been putting in my stop losses after the market opens each day. So let's look at another one here. IR. I actually got into this afternoon after I got out of it yesterday, and when I got out of it yesterday, it was pushing right through these moving averages. I didn't like the price action. I felt like I had some better setups to put into play rather than just sitting on this one while it pulls back. Well, we got out of it for less than a 1% loss on it, which is nothing really. It doesn't bother me that happened. And then today it actually starts improving some, doing what I was expecting it to do yesterday, and it does that. So I actually got back into it, and it wasn't out of revenge or anything else. I actually really didn't want to get back into it, but the trade setup was great. And that's the thing with trading, is you can't hold these symbols. They're just letters, and you're just trading charts. That's all it is with technical analysis. You're just trading charts. Who cares about the company and who cares about the stock? I mean, for Pete's sake, we're in PAY right now, Verifone. I don't even think, do they have customers? I don't know, but their charts goes up, so I buy it, okay? But the IR, we got back in it because the chart looked pretty darn good, and we can keep that risk tight, okay? We can keep the risk tight, and we can play this thing to the upside. So we stand to maybe lose 2.5% if the trade goes against us, and to the upside there might be 4, 5, 6% to be made. So it makes it a worthwhile trade. ARUN, let's talk about this one. This stock literally has been on my watch list for, I could probably tell you here, let's see, this since the beginning of October, okay? So well over a month, and that's sort of long for a stock to be on my watch list. We got stopped out of it today. This is what I've been watching on this thing. This triangle pattern, it's ideal, and I got really excited yesterday because we were going to break out, and we did break out yesterday, and we got in at like 18, I can't remember the exact price we got in at, but right where this thing breaks out at, okay? So like 1872, I think it was 1872 we got in at. And then Cisco reports earnings, right? Well, first of all, I'm not following the Cisco earnings when it comes to ARUN. I know that they're related and everything, but if you do that, you'll find a reason not to ever trade any stocks, quite honestly. So you gotta avoid that, quite honestly, to overanalyzing stocks. And know what you're gonna trade and what you're gonna trade based on. In ARUN, we're trading and we use technical analysis and chart patterns, and that's what we are basing our decisions on with this stock. So the stock, it breaks out yesterday, and then the Cisco obviously messes up the whole thing. And you know what? That's just part of trading. I don't like losing 2.5% on a trade. I hate it. Okay, but I have to put those emotions aside and say that is part of trading. There's nothing that could have been done to change that outcome of that trade because of what we knew yesterday when we got in, when we held it overnight based on what we knew then. This is how it turns out. So trades like this, it's part of doing business, quite honestly. Now on the other hand, PAY. We were talking about Verifone just a moment ago. We're in this stock. We're up about 7% on this trade, and it just keeps pushing higher. and the stock looks great. Honestly, I don't even know why people are still, you know, paying money to these companies for their services, because they seem a little bit behind the times, but maybe that's just my ignorance. But the chart looks great. I mean, you can look at it from a long-term perspective. You had this inverse head and shoulders pattern breaking out, looked beautiful. And GES yesterday we booked for 7.7% in gains. It's given it a little bit of it back today, but huge upward move yesterday of about 6%. We took those gains. We have been in it for a while, but it's treated us very nicely, and so. So nothing to regret there at all. Let's look at AAPL. Obviously, Apple. And a lot of people are still trading this stock. I mean, I think the developments of the past couple of weeks looks really good. I think this is a similar pattern that we're seeing out of CE, LVS, and they're both doing pretty well too. But AAPL. I would say be a buyer here. I think there's a lot of support there. Put a stop below. Geez, this is really good actually, folks. You can put it a stop loss at like 511.20 and get in at 527. I think there's a good chance you may see 560, 570, 580 out of that stock here in the not so distant future. So a very positive. I really like this trade. I like how it's pulled back on light volume. I think it's going to start seeing some more buyers come in here, especially when it gets above 540. And then let's look at Amazon. We were short this stock. We got out of it yesterday when we saw that the market was breaking out to new highs. It was a hedge for us because back on Tuesday, it was looking very bearish. We knew that it needed to get through that 20-day moving average. It didn't do that. But once it bounced off of that, we went ahead and covered our position. And this is how fast charts can flip around. And people have a hard time with this concept. But a chart can go from being very bearish to very bullish in a matter of hours sometimes, or days or whatever. But when that happens, you got to be cognizant of that. Right now, it's breaking out to new highs, 365. It looks like a very good bullish chart. You could get in at 366 and you could put your stop loss, put it at 344, and you got about $21 to play with on that. A little bit more risk than I would want to play with on an individual stock, but for some that's ideal. So Facebook. This one continues to look bearish, and I think it has been part of the reason why the NASDAQ has also looked bearish in recent weeks. But, obviously with Amazon, busting out, Apple still improving yesterday's large market move as well. It's back to trading at highs, but it hasn't confirmed new highs like the S&P has. And then you got the RUT as well that is definitely a bearish divergence because it is nowhere near its highs yet. So that needs to get rectified, fairly quickly, or we could see something like the August 2nd where we get the follow through on the August 1st breakout on the S&P, and then we sell off afterwards. So that's something to keep in mind as well. All right, I think I've covered pretty much everything I'm going to cover today. Be sure to pick up my book, The Part-Time Trader. It's my first book ever that I've written. It's published through Wiley & Sons. You can pick it up on BarnesandNobles.com. You can go to Amazon.com. You can go to BooksAMillion.com. You can Walmart.com. I mean, it's everywhere. Pick up a copy of it. It's a great book. If you have any questions, you can always email me, Ryan@SharePlanner.com, and I always get back to everybody on email. And if you haven't also done so yet, subscribe to the Splash Zone. Try it out for 7 days. Free trial offer. Oscar does a great job. I'm so privileged to have him as our day trader on the Share Planner Splash Zone. He does a great job. I do the swing trades, and it's just a really good package that you get all for one price. So 7-day trial for free. If you don't like it, you can always unsubscribe. No questions asked. And that's about it. So you guys have a great rest of the day, great weekend that's shortly coming around the corner here, and God bless you all.